Our topic today is about Nigerian crypto traders and liquidity. Millions of young Nigerians are now active in the crypto market, trading Bitcoin, USDT, Ethereum, and Solana. This phenomenon is as a result of the Nigeria economy decline. Since the 2020 pandemic, Nigeria has seen a 25% decline in its local currency, the naira. But as a result, since 2020, Bitcoin have appreciated at about 400%. So the young professionals that trade in Bitcoin don't just see Bitcoin as an asset. They see it as a way to hedge against poverty, and they see it as a way to hedge against the devaluing naira on a constant basis. Nigeria is among the top 5 countries in the world that use crypto as a trading transaction. They don't just keep it in their digital wallet and wait for it to appreciate. They actually use it for their day to day trading. The danger zone with this is most platforms where trading are done, they let traders use leverage. I'm not saying leverage is a bad thing. If you know what you're doing, a lot of people have made a lot of money by leverage, borrowing from your brokerage firm that lets you trade and quadrupling your amount. This can be a game changer. This is what takes people from a regular Joe to a good trader, somebody that makes a whole lot of money. But what happens when an average Joe trades from his computer at home and they compete with quant firm? A quant firm is, I would say, a regular company that trades in the crypto or in the stock market. The distinction is they don't use intuition to trade. They use analysis, mathematics, equations, and models. So around late 2025, there was a pattern that occurred, and a lot of crypto traders started noticing it. It was called the 10 a.m. phenomenon, or in Nigeria, it would take place around 3 p.m., where they would notice the price of Bitcoin would drop at exactly 10 a.m., which would trigger a lot of call options. And as this triggered a lot of call options, small traders were wiped out of the market. This usually happens as a result of the leverage. So, like I said, good or bad is hard to tell. I am not saying leverage is bad. What I am saying is when there is a tank in the market or a drastic change in the price, the leverage or the company that loans money actually calls this money, which results in a lot of players being out of the game. Nigeria have a lot of small traders. And when I mean a lot of small traders, I mean people that trade in the stock market between $100 to about $10,000. That's about 70% of the traders in Nigeria. And this 10 a.m. phenomenon or 3 p.m. Nigerian time phenomenon has been analyzed by a lot of crypto traders as a liquidity trap, right? Not in the concept of a liquidity trap, but in the concept of these traders that trade in the market, they lose their money because their accounts are being called, right? So what this means is if you loan money from Binance and you have a leverage that says Bitcoin will not drop below, for lack of a better example, I would say $10. But during the 3 p.m. liquidation in the market, Bitcoin drops to about $8. By default, the $10 that was loaned from your brokerage firm has to be called because the brokerage firm is trying to limit its losses in the market. And by limiting its losses, this gets a lot of people out of the market and in some situation in debt. As a result, understanding the stability of the market and seeing how it affects young traders in Africa is necessary. The spoiler is most people that trade in Nigeria are usually people trying to pay their rent, trying to put food on their table. They are not organized firms. They don't have PhD in mathematics. They don't use lots of digital quant or drives, and they don't use algorithm to make their decisions. They use intuitions and they actually wait for the news to see where the market goes. So with the liquidity trap or the 10 p.m. phenomenon, the funny part of this story is around February, a lawsuit was filed against a firm. And once that lawsuit was filed, the 10 a.m. dip in the price of Bitcoin, or in Nigeria, the 3 p.m. dip in the price of Bitcoin actually stopped. And this was going on from late November 2025 all the way to February 2026. And as a result of this phenomenon happening, a lot of people got wiped out of the market. Now, the firm that was sued said they had done nothing wrong because they actually played according to the playbook, citing the SHO Rule 200, which allows the firm to actually expose its long position, but on the other hand, hides its short position. Now, when the average Joe is trading and they see big major companies buying lots of bitcoins or placing leverages in bets on a long call, this gives the average Joe or the average trader the illusion that they're following the market, right? Or they're following the market's animal spirit, which is kind of optimism and pessimism and what's going on. But on the other hand, they are unaware that the same firm that placed a long position, and by law, under the SHA rule, they are allowed to show this their long position. This also allows, that rule also can prevents them from showing their short positions. So the myth is people at that point start believing that the price of Bitcoin followed the traders' optimism and pessimism, but they were relying to say that what was going on in the market was an artificial glitch rather than letting the economy or the ups and down of stock markets or gold or petrol to affect the price of Bitcoin. The lawsuit claimed that Bitcoin was being manipulated by a particular firm. And as a result, it cost a lot of people money and it cost a lot of people to lose. So, what is a quant firm, right? Because this whole deliberation or the whole allegation is faced under a particular quant firm.